Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, June 28th, just after the close. John Mousseau, our President, CEO, and Director of Fixed Income, is with me today, and we'll have a couple of comments on the bond market. First, more exciting news for Cumberland. Gabriel Hammett last week was on the video mentioning that we were named by the Sarasota Chamber of Commerce as Professional Services Small Business of the Year, something we're very proud of. This week, the Financial Times, one of the world's leading business publications, came out with their list of the top 300 RIAs in the country. Included in that top 300, Cumberland Advisors. So it makes our hard work worthwhile and puts a smile on our face. Keep in mind, there's over 12,000 SEC registered RIAs in the country. Okay, we're going to head over to John. We've been watching these bond yields come down, crash on the 10-year Treasury through 2% for a few hours days ago, and now settled just over 2. John has some thoughts on both the Fed and what we might see yield curve-wise.
Thanks, Matt. Well, it certainly was a whirlwind quarter, and we saw the 10-year government bond drop from a 2.40 all the way down to a 2%. That is a big drop for a quarter, and when you put it in percentage terms, even more so. And muni yields followed right along with it. So you now have long muni yields really almost below 3%. That is also a big drop, particularly since the beginning of the year. What was also interesting is the fact that you had the Federal Reserve have their meeting this week, and whereas they did not cut rates, they changed their language to make it appear they will be more accommodative. The markets have already priced in that action and think the Federal Reserve will cut rates twice within the next 6 months to the end of the year. Here at Cumberland, we have a little bit of a hard time digesting that, because when we look at the landscape, what do we see? We see 2% inflation. It's come down a little bit, but it's still around 2. You see unemployment down around 3.6, a low that we haven't seen in a while and has not come up. It is very hard to find workers. You see real GDP growth up around 3. With GDP growth at 3 when it used to be 2, you add all these up, plus a very good stock market, and you wonder, where is the economy declining? We don't see it. We see a partial slowdown. If you hearken back to the last time that you had a flat yield curve like you do now, that was 2006, the economy continued to do well for a couple of years. So, whereas the market is starting to price in the Fed cuts, we're taking a somewhat more benign look at it, and we're doing that with the knowledge that the markets most of the time do a lousy job of forecasting rate cuts. So for us, it means we're playing defense on bonds and waiting for rates to rise.
And when you say defense on bonds, John, are you saying you've shortened our duration and taken maturities in a bit?
Correct, particularly on the duration side, which means we own less price-sensitive bonds. So you may have owned a 5% 30-year muni bond with a 10-year call or 4% coupon. Now we're looking at bonds that have shorter calls and the same coupon, so that the price movement doesn't fluctuate as much, because if you believe your next step is to probably go higher in rates, you want your price movements to be a little more dampened.
Gotcha. Thank you. Equity-wise, kind of a benign week in the world of the S&P 500, but under the hood of the market's very interesting this week. Small caps, as represented by the small cap 600, up almost 2%, call it 1.9. Mid caps, as represented by the mid cap 400, up over 1.25, call it 1.3, with the S&P 500 off nearly 0.5%. Now, we've been on here before talking about seeing short-term strength in small caps, short-term strength in mid caps. Can it continue? Where does it fit into an allocation? We'll see if this is a head fake or not. We do have a lot of earnings growth priced in to large cap growth. It seems like it could be getting, and perhaps is, a little bit of a crowded trade. Maybe it's time for small caps to rally a little bit, mid cap as well. We'll be able to adjust allocation if that's the case. We do have some exposure to small and mid cap in both our US ETF and in our tactical trend. In our holdings, both in small and mid cap, they're tilted growth, specifically in tactical trend, which owns IJT, which is small cap growth. Not many moves in our equity portfolios this week. One move in tactical trend, which is a flexible allocation strategy. We added to our insurance position. It's been on here for 3 or 4, could be 5 months now, talking about the strength we're seeing in insurance. Is that a leading indicator, a leading move for financials? Well, insurance went out at highs last week, pulled back a little bit midweek. We added 2%, took that holding up to 10% in tactical trend. Been a wonderful holding. Banks have followed late in the week. Be nice to see financials get a move higher here. Try to broaden some of the breadth in the market. So we'll see what next week brings. Could be a tricky week, spotty week in terms of volume, with the market on a early close Wednesday and then July 5th falling on a Friday. We'll see what it brings. We will be here on Friday to let you know what we're seeing. Have a great weekend.